You're watching via news, AI-powered machine-fast market ready. I'm Max with Emma and Zoe, your AI anchors. We process market signals across thousands of sources simultaneously. No financial conflicts, no deadline pressure. Analog Devices posted $3.16 billion in cone revenue, up 30% year-over-year. The stocks gained 57% year-to-date as AI infrastructure spending drives semiconductor demand.
Here's the key signal. Semiconductor names outperformed despite the 10-year Treasury climbing from 3.97% to 4.32%. Rising rates typically crush growth stocks, but AI conviction is overriding rate sensitivity. TSMC, joining the EPIC platform as a founding partner, confirms sustained fab buildout, which directly feeds equipment demand for Applied Materials and analog chip makers.
Watch for Applied Materials guidance on their next earnings call. If they raise CapEx projections, it signals hyperscaler spending is locked in through 2027. That's your confirmation. The semiconductor rally has fundamental backing.
Pershing Square is building a new Microsoft position while Oracle takes on debt, not equity, to fund data center expansion. Both moves signal institutional conviction ahead of broader market recognition.
This is textbook smart money behavior. Oracle's debt-funded CapEx is particularly telling. Management is betting with leverage, not hedging. Pershing Square doesn't make passive moves. A new concentrated position in Microsoft signals they see Azure's AI monetization path as durable. The pattern suggests institutions are accumulating before the AI infrastructure narrative fully prices in.
Track the next 60 to 90 days for continued institutional accumulation across MSFT, ORCL, Amazon, and Google. When retail and passive flows catch up, expect a sharp re-rating of these names.
EBS Group surged 15.72% on cone earnings, marking a sector shift from speculative AI plays to companies with auditable revenue streams.
The market is re-rating GPU cloud operators from growth stories to proven revenue models. That distinction matters for valuation multiples. Recurring, contracted compute demand commands higher prices than promises of future cash flows. AI infrastructure companies with secured power agreements are positioned for multiple expansion.
Earnings season for this sector now carries real weight. Watch for AI infrastructure operators that can post credible quarterly numbers tied to contracted demand. Each positive surprise reinforces that compute demand is translating into business fundamentals.
US CPI, PPI, and import prices forced markets to reprice rate cuts sharply lower, driving dollar strength. ECB's Pat Salides warned inflation risks are worsening, flagging a potential June hike.
The global easing narrative is unraveling across three major central banks: Fed, ECB, and BOJ, all pivoting toward restraint. JGB yields spiked to historic levels while euro weakness accelerated. Yet equities rallied on US-China trade progress, creating a gap between rising yields and advancing stocks that reflects competing monetary and trade forces.
Watch for Fed funds futures pricing. If hike odds continue creeping higher, it confirms the easing cycle is over. That supports continued dollar strength and pressures emerging market assets.
UK 10-year gilt yields surged to 5.1% as sterling sold off on political pressure threatening the Starmer government and a proposed banking surcharge, hike from 3% to 5%.
Rate-sensitive sectors, housebuilders and banks, led equity losses as borrowing costs spike. The political crisis amplifies existing fiscal concerns, while Fed futures pricing only a 1 in 3 chance of rate cuts means no global anchor to stabilize UK flows. The banking surcharge directly hits financial stocks already pressured by rising yields.
Track sterling's technical levels. If it breaks key support, expect further gilt yield spikes. Without Fed easing to anchor global rates, UK assets remain vulnerable to any political instability.
AI-powered analysis, real-time market intelligence. This is via News Network.